So here it is. NIO has received the first major downgrade by one of the analysts. This time I think it's Edison from Deutsche Bank. And nobody wants to get downgrades, right? But on the other hand, it was kind of to be expected, to be honest. And so in this video, I'll quickly walk you through it and give you my personal views on that. In the moment that I'm recording, NIO is down almost 4%, but I don't think really that the downgrade is responsible for it. We see an overall drawback by some of the growth names, particularly the Chinese names. I think it's rather a kind of a risk-off move today with oil spiking, and you can see that NIO kind of has tested this the resistance here from this channel actually, and now also the support level here from this overall downtrend. So kind of a little breather here and kind of to be expected for a day like this. I think only in the next coming days we'll rather get a direction whether or not this rally can be sustained or if we are about to revisit the lows here. Okay, now let's talk about the news that Deutsche Bank analyst Edison has lowered their price target from $70 to only $50, but maintaining a buy rating. I'm not going to talk about their expectations for the quarter. You can obviously read this article and their estimations and views around the quarter yourself. Instead, I'll jump straight to why they have lowered the price target and while maintaining the buy rating. And so here's the explanation. We lowered our price target by $20 to $50 based on a 5x 2023 estimate enterprise value to sales or 40 to 50% discount to US comps such as Tesla or Lucid versus prior 8x to account for the derating in Chinese ADR following concerns about delisting, geopolitical risk, but reiterate our buy rating, seeing significant long-term upside once the shareholder base stabilizes and NIO gets credit for the upcoming product cycle inflection. So what does it tell us? Well, basically it tells us that on the fundamental side, he's actually not kind of changing his views on the company. So basically still saying, without going into the details here, that NIO will be producing X amount of cars, grow that amount and have those kind of opportunities to tap in, which he always been saying before, and he's not making real changes to that, and based on that downgrading the stocks by $20 from $70 to $50. No, instead what he's doing here, he's adjusting the multiple and reducing it from an 8x enterprise value to sales to a 5x enterprise value to sales. And what he is doing here, he's basically just adjusting to the market, because if you look at this graph, this is how NIO has been valued on this metric over time. So with a peak in January, February 2021, when the enterprise value to sales ratio was at a high of 52x, while now it's down to 5.4x. And what's the analyst doing here? He's basically using this new multiple that is also given by the market currently. Like, how is NIO currently valued? It's currently valued 5.4x enterprise value to sales ratio, and he's applying that one into the future. So basically saying in 2023, when the 12 months target is in place, the multiple will actually still be there. And so in this scenario, what will happen is that the company, the underlying company, will be growing and keep making revenues and growing their revenues, and valuation multiple given will actually stay the same at this low valuation metric here. You don't have to agree or disagree with that. That's simply what he is doing. It's given him the option that once let's say the geopolitical risk improves and let's say other things like the delisting fear is going away, to improve this multiple again. And well, obviously we have seen those multiple contraction everywhere in the market, not only with NIO. We've seen it with Chinese stocks, of course, with some arguments around perceived risk of the ADRs, the VIE structure, geopolitical, delisting and such. But we've also seen it, frankly, with many other names, like with Palantir, with Teladoc, with all of the ARK Invest names, all of the non-profitable growth names, all of them have seen their multiples contracted and becoming lower. And basically, we could see analyst price target also coming down because of that, because they're now saying, well, we will keep to those low multiples. And that basically in the US stocks is a different narrative. They say it's because of the inflation and less appetite for risk assets and growth assets. Anyway, you see it. I think over time we just need to be flexible. These multiples will also change again. And so this is kind of the rundown here, why this has happened. But to also give you a little bit of a perspective, what is actually driving the stock performance, so meaning the stock price in the very long time or the long run, is what you can see here, differentiated between free cash flow, so that's the blue, the multiple, and that's the yellow one, and that's what Edison Yu, the Deutsche Bank analyst, just adjusted, and the margin of the company, that's in green, and revenue growth, that's in light blue. And you see that over a 10-year period of time, the main driver of the stock price performance is actually sales and profit. If you talk about the margin and the revenue growth, this combination is ultimately what's driving the stock price performance over time. Only 5% will be an increase or decrease in the multiple over a long period of time. However, in the short term, if you look at a 1-year timeline, yes, 46% of the stock price performance is actually due to multiple changes that can fluctuate to macro factors just like the economy and things like that. But in a very long time, it is actually the stock or the company, the fundamentals, the underlying growth of the company that is driving the long-term performance of the stock. So I hope this gives you a little bit of a context and you liked the video. If so, please let me know down in the comments, smash a like, share the video, subscribe to the channel, and you may also want to consider to become a patron. Thank you guys for watching and see you in the next one.